Welcome back, dear students and scholars. Today we are entering one of the most important safety zones in ASC 323. What happens when the investee keeps losing money? In earlier videos, income increased the investment account and dividends reduced it. But losses can push the investment account all the way down to zero. The big question is, do we keep recording losses after that? This video gives you the stopping rule, suspended loss logic, other investment allocation, and later recovery treatment. Loss accounting is serious, but do not worry, we will keep it controlled. The investment account may hit zero, but our clarity will not. Under ASC 323, the investor normally recognizes equity method losses only up to its economic exposure. That starts with the investment carrying amount, but it can also include additional financial support the investor has provided or committed to provide. Once that exposure is exhausted, additional loss recognition generally stops. So the ceiling is not based only on ownership percentage. It is based on how much the investor can actually lose. The practical rule is this: recognize losses up to the investment carrying amount plus committed financial support and stop when both are exhausted. The ceiling is not always limited to the common stock investment account. If the investor has provided capital support, loans, advances, guarantees, or funding commitments, those items can extend the amount of loss the investor must recognize. The reason is economic exposure. If the investor is still financially on the hook, the accounting cannot pretend the exposure has disappeared. A guarantee or binding funding commitment can push loss recognition beyond zero in the basic investment account. In simple words, the balance sheet asks, are you still exposed? If the answer is yes, the loss model keeps going. Equity method loss recognition normally stops when two conditions are met. First, the investment carrying amount has been reduced to zero by cumulative losses. Second, the investor has no further obligation, guarantee, committed support, or other investment in the same investee. When both conditions are present, the investor suspends additional loss recognition. That means no more losses hit the income statement for now. But suspended does not mean deleted. It means the losses are waiting in a tracking schedule for future recovery accounting. Suspended losses must be tracked carefully. They are not recognized on the statement of financial position when the investment account is already zero and no further exposure exists, but they still matter. The investor maintains a memorandum schedule showing the suspended loss balance. This schedule becomes important when the investee later returns to profitability or when the investor makes a new investment in the same investee. So the memory line is perfect. Unrecognized does not mean forgotten. In accounting, even losses that leave the financial statements often leave a forwarding address in the work papers. When the investee later becomes profitable, the investor does not immediately recognize equity method income if suspended losses remain. Later income first clears the suspended loss balance. Only the excess income, after the old suspended losses are absorbed, is recognized in the current income statement. Think of suspended losses as standing in line before new income. They were waiting from prior periods, and accounting politely says, please clear the old queue before celebrating the new profit. That queue system prevents the investor from skipping over losses that were economically incurred but not previously recognized. The recovery sequence must be applied in order. First, confirm the opening suspended loss balance. Second, calculate the investor's share of current investee income. Third, apply that income share against suspended losses until the suspended balance reaches zero. Fourth, recognize only the remaining income, if any. This sequence keeps the model consistent. The investor cannot recognize new equity method income while older unrecognized losses remain unresolved. So, recovery is not just about profit returning, it is about profit first repairing the loss history. The suspension rule does not apply when the investor still has real exposure. If the investor has guaranteed investee debt, has a required funding obligation, has made a legally binding commitment, or has a substantive support arrangement, losses may continue even after the investment account reaches zero. The logic is simple. If the investor is still economically responsible, the income statement should reflect that exposure. A zero investment account is not a magic shield. If the investor is still standing behind the investee, the accounting follows that obligation. When the investor is obligated to absorb losses beyond the investment balance, the investment account is reduced to zero first, and then additional losses may create a liability. The entry debits equity in losses of investee and credits liability for investee losses. This is important. The investor should not casually show a negative investment asset. A negative asset usually does not make sense unless it represents an obligation. If the investor has a recognized obligation, the balance sheet should show a liability. The asset floors at zero and the obligation takes over. Now let us apply the simple 2026 loss example. Orion Capital owns 30% of Cedar Bio. Orion's opening 2026 investment carrying amount is $90,000. Cedar Bio reports a 2026 net loss of $400,000. Orion has no guarantees, no commitments, and no other investments in Cedar Bio. Our task is to determine how much of Orion's share of loss is recognized and how much is suspended. This is the clean version of the zero floor rule before we add other layers. Orion's share of Cedar Bio's 2026 loss is $400,000 times 30%, which equals $120,000. But Orion's investment carrying amount is only $90,000 and Orion has no further obligations. So Orion recognizes only $90,000 of loss, enough to reduce the investment to zero. The remaining $30,000 is suspended. The journal entry is debit equity in losses of Cedar Bio for $90,000 and credit investment in Cedar Bio for $90,000. The account reaches zero and recognition stops there. After recording the entry, Orion must document the suspended loss reconciliation. Total investor share of the 2026 loss is $120,000. Loss recognized is $90,000. The investment carrying amount after recognition is zero. Suspended loss carried forward is $30,000. This reconciliation is not optional. It is the foundation for the next period's accounting. The income statement stops at the recognized amount, but the suspended loss tracker continues running quietly in the background. Quiet does not mean unimportant. It means the work paper is doing its job. Now, Cedar Bio returns to profitability in 2027. Cedar reports net income of $150,000 and Orion still owns 30%. Orion's share of 2027 income is $45,000, but Orion has a suspended loss balance from 2026 of $30,000. Before Orion can recognize any equity method income, that suspended loss must be cleared. So, even though the investee is profitable, the old loss history still controls the first part of the accounting. The recovery reconciliation is straightforward. Orion's share of 2027 income is $45,000. First, subtract the $30,000 suspended loss recovery. That leaves $15,000 of recognized 2027 equity income. The investment carrying amount is restored from zero to $15,000. The journal entry is debit investment in Cedar Bio for $15,000 and credit equity in income of Cedar Bio for $15,000. The full $45,000 of income helped the recovery, but only the excess after clearing suspended losses reaches the income statement. Now, the loss model becomes more complex. Sometimes the investor holds more than common stock. It may also hold preferred shares, debt securities, loans, advances, or other interests in the same investee. If the common stock investment reaches zero, ASC 323 may require additional losses to be applied against those other investments. Why? Because those instruments represent additional exposure to the same investee. So we must look beyond the common stock account and ask what else the investor has at risk. Loss allocation follows the seniority ladder. Common stock is usually the most exposed layer, so it absorbs losses first. Preferred stock is more senior than common stock, so it absorbs losses after common is exhausted. Debt is usually the most senior claim, so losses reach debt last. This mirrors liquidation economics. In a business failure, common holders are normally the first to suffer, and creditors are usually protected longer. The accounting follows that economic order. It is not just a technical sequence, it reflects who is really at risk first. Common stock absorbs losses first because common shareholders bear residual risk. They accept the weakest claim in exchange for potential upside. Under the equity method loss model, that risk position is reflected by reducing the common stock investment carrying amount before touching more senior interests. Only when common stock reaches zero do we consider preferred stock, debt, or other investments. This is important because it prevents the investor from protecting common stock while charging losses to more senior instruments too early. After common stock is exhausted, losses may move to preferred stock or similar equity interests. Preferred stock is usually senior to common but still generally below debt. So, if the investor holds preferred stock in the same investee, the adjusted basis of that preferred investment can absorb additional losses after common stock is reduced to zero. The memory line is useful. Move upward through the capital structure only as needed. Stop as soon as losses are fully absorbed. Do not climb the ladder just because the ladder is there. Debt absorbs losses last because it normally has the most senior claim. But even when losses are allocated to debt securities or loans, ASC 323 does not replace other GAAP. Loans and receivables may fall under ASC 310. Debt securities may be governed by ASC 320. Credit losses may require ASC 326 analysis. So, ASC 323 tells us how equity method losses affect the adjusted basis, but the instrument specific guidance still applies afterward. One standard does not cancel the others, they work in sequence. When applying losses to other investments, we use adjusted basis, not original cost. Adjusted basis begins with original cost and then reflects write downs, fair value effects where applicable, premium or discount amortization, credit allowance effects, and prior equity method losses already applied to that instrument. This matters because the investor's current exposure may be different from the price originally paid. Using original cost after years of adjustments would be like using an old map in a city that has built three new bridges. The current basis is the number that matters. ASC 323 loss allocation and other GAAP work together. ASC 323 determines how much of the investee's loss is allocated to each investment layer. After that, the investor applies the relevant standard for each instrument, such as ASC 310 for receivables, ASC 320 for debt securities, ASC 321 for certain equity securities, and ASC 326 for credit losses. The sequence is important. First, adjust the basis through ASC 323 loss allocation, then apply the instrument specific measurement and impairment rules to the adjusted basis. Now let us use the multi-layer loss allocation case. In 2028, Mira Holdings owns 40% of Lyra Medical common stock. The common stock investment carrying amount is $20,000. Mira also holds Lyra preferred stock with an adjusted basis of $50,000 and Lyra debt with an adjusted basis of $30,000. Lyra reports a 2028 net loss of $300,000. Mira's share of that loss is 40% of $300,000 or $120,000. We must allocate that loss across the investment layers. Mira's $120,000 loss share is allocated by exposure and seniority. Common stock absorbs $20,000 and goes to zero. Preferred stock absorbs $50,000 and goes to zero. Debt absorbs $30,000 and goes to zero. That accounts for $100,000 of invested capital. The remaining $20,000 is suspended because all positions are exhausted and there is no further current obligation. The total allocation is 20,000 plus 50,000 plus 30,000 plus 20,000 suspended, which equals $120,000. The table closes and the logic follows the risk ladder. When Lyra later returns to profitability, recovery reverses the prior loss allocation path. The slide shows that the most senior investment, debt, is restored first, then preferred stock, then common stock, and only after the relevant layers and suspended effects are dealt with does income flow to the income statement. The important teaching point is that recovery is not random. Later income does not immediately become current income just because the investee recovered. It first repairs the loss allocation history. In equity method accounting, recovery has memory. A new investment after suspended losses requires judgment. Suppose the investor makes an additional investment in the same investee after loss recognition was suspended. We cannot answer the accounting mechanically. We must ask whether the new money funds prior investee losses or whether it represents a separate fair value purchase of an ownership interest. Source of purchase matters. Fair value received matters. Ownership increase matters. Seniority matters. This is one of those areas where the accounting memo cannot be one sentence long. The facts need to be read carefully. The substance of the new money drives the accounting. If the contribution effectively covers prior investee operating losses and the investor receives little or no fair value in exchange, suspended losses may need to be recognized through a catch up loss entry. But if the investor purchases an interest at fair value from a third party and the investee receives no new cash, automatic catch up loss recognition is not appropriate. The best question is the investor receiving fair value for the new contribution? If not, the contribution may be funding prior losses. Now consider the new investment entry. The investor contributes $100,000 directly to the investee, and the facts indicate that the contribution funds prior losses. First, record the new investment. Debit investment in investee for $100,000 and credit cash for $100,000. Second, recognize the suspended loss. Debit equity method loss for $30,000 and credit investment in investee for $30,000. The ending carrying amount is $70,000. That is $100,000 new investment minus $30,000 of suspended loss now absorbed by the new funding. Here is the classic exam trap: creating a negative investment account automatically. A learner records the full investor share of losses and allows the investment account to become negative. That is usually wrong. Under ASC 323, stop loss recognition at zero unless the investor has a legal obligation, guarantee, committed financial support, or other investments in the same investee that can absorb additional losses. A negative investment account requires exposure beyond the basic investment. No exposure means no negative balance. The investment account is not a black hole, it has a floor. Let us recap the complete loss model. recognize losses up to the investment carrying amount and committed support, suspend losses when exposure is exhausted, track suspended losses carefully in a memorandum schedule, use later income to recover suspended losses before recognizing new income, apply losses to other investments by seniority when required. The final memory line is the best summary. Loss accounting follows economic exposure, not just ownership percentage. That single sentence can protect you from most mistakes in this area. In the next video, we move to impairment, ownership changes, and special structures. We will study other than temporary impairment, increases and decreases in ownership, discontinuing the equity method, partnerships and joint ventures, and tax credit arrangements. If this video helped you understand loss ceilings and suspended losses, please like the video, subscribe to Commerce Regiment, support the channel, and share it with students, scholars, and colleagues who are serious about US GAAP. Your support keeps this course moving with clarity and depth. I will see you in ASC 323 Video 7, where the equity method meets impairment changes and special structures.